Intermediate Accounting 3B, Accounting for Bonds and Bonds Issued for a Premium. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page and our email. The website and the book, Cost Accounting for Dummies, that's now available on Amazon.com. This discussion starts with a blog that I did on February 13th, 2013. And it's my basic beginning of a discussion about accounting for bonds. And I find that this area isn't explained very well. And particularly difficult is the section on premiums and discounts on bonds. And I hope that this helps both the blog post and the video. I was in the investment business for 4 years with my dad, and we sold exclusively bonds. And so I had to explain to investors premiums and discounts on bonds for years. So hopefully some of that stuck with me and I'm able to explain it a little better. And for this discussion, I want to talk about a corporate bond specifically, a bond issued by a corporation. So for the corporation, that bond is a debt instrument, They get cash in exchange for issuing debt. I'm going to make a note here as we go. For corporate bonds, the interest payments are usually semi-annually, twice a year. That's the standard that you'll see, particularly with CPA exam questions. Now, there's two flows. There's the interest payment flow to the investor. There's also the repayment of the principal amount, which is another way of saying the original amount issued at maturity. And an important thing to remember as I get into bond terms is that all the important information that an investor needs is printed on the face of the certificate. So it's a good disclosure rule. So face amount is the dollar amount of the bond when it is issued. Now, once it starts trading in the marketplace, that's how we get premiums and discounts. The value of the bond in the marketplace may be higher or lower than the face amount, but it starts off at issue almost all the time at the face amount. Corporate bonds are issued in increments of $1,000. Interest rate, the percentage of the face amount that's paid as interest income. So if it was a $1,000 6% bond, if I take 6% of 1,000, the interest is $60 a year. I already mentioned semi-annually, twice a year. The issuer is the corporation that sells the bond to the public. Maturity date, as you saw just above, was the date that the issuer repays the face amount, the original issue amount of the bond, to the bond buyer. Now, there's a complication that I just mentioned. Once the bond starts trading in the marketplace like any other security or any other investment, the value in the marketplace, the market price, can change, and that's how we end up with premiums and discounts. So a bond's issued for $1,000. Bonds trade in the marketplace. Because they trade and they're bought and sold, it's not surprising that the bond prices change. So two terms about bond prices. A premium bond is a bond that is priced above the face amount, above $1,000. So if a bond is selling at $1,010, which is possible, it's selling at a premium. Flip side, discount. If a bond is priced below face amount, it's priced at a discount. We're used to hearing about discounts. Walmart is a discount retailer, sells stuff at a lower price, so that's how we remember discount. Premium seating in a movie theater are better seats, so that's a way of remembering premium or better is above the face amount. Discount like a Walmart, cheaper price, below the face amount. The question that I used to have to answer all the time, why would anyone buy a bond at a premium? Why would they pay more than the face amount? And the best way to answer it is through an example. Let's say that we issue a $1,000 7% bond, and it's due in 10 years, 10-year maturity date. And a few months later, interest rates fall. Now, issuers are issuing 10-year bonds at 6%. as an investor, particularly if you live in a fixed income, which a lot of my bond customers did, most of them did, you'd prefer to earn 7% as opposed to 6%. So you'd be willing to pay more than $1,000 to get the 7% interest. Let's assume you're willing to pay $1,100 or $100 above the face amount. Well, here's the result in terms of cash flow. You pay $1,100 for the bond, but at maturity you only receive the face amount or $1,000. So in that part of the transaction, you lose $100. You pay $1,100, you only get back $1,000. That's the bad news. The good news is you earn 7% a year instead of 6% a year. And the way I explain it to my bond customers is you need to look at the total return on the bond. And there's a term for that. In finance, it's described a little more complicated than I'm going to put it. But really, total return is another word for yield to maturity. Yield meaning some sort of return. And I mentioned before today that there are two cash flows that make up your total return. One is that gain and loss you incur when you buy the bond and the bond matures. In this case, that's a $100 loss. But there's another cash flow in that you're going to earn 7% a year as opposed to going out and buying a bond at face value that only paid 6%. So, bottom line is, you may find, and there's easy ways to calculate this, that the 1% higher interest payment over 10 years more than offsets the $100 loss at maturity. That's a subject for other videos that I have out there to calculate what's called the effective interest rate method. I'm going to go a little farther here and talk about a bond at a premium. So remember, a premium is a bond that is issued at something more than the face amount. Something that is trading at more than the face amount. I made a mistake because when an issuer issues the bond to the public, corporation to the public, that bond is almost always issued at face amount when it goes to the first buyer who is in the public. From corporation to the first buyer, the bond is issued at a face amount, usually $1,000. Okay. However, it's possible, without going into the why, that a bond could be issued at a premium. Let's say that the $1,000 bond's issued at $1,020. Now, you'll see other intermediate accounting videos on bonds that I have that I look at journal entries from the issuer's point of view and from the investor's point of view, two sets of entries. This is the journal entry from the issuer's point of view. You're going to get cash in the door of $1,020. You're only obligated as the issuer to repay $1,000 at maturity. To make the debits and credits equal, I need a $20 credit, and that credit goes to an account I call premium on bond payable. So now debits and credits both total $1,020. And I put in parentheses to record a $1,000 bond issued at a $20 premium. And I go into a little more detail here in this paragraph that we've already gone over. Now, let's think about that premium on bond payable. The difference between what the issuer pays at maturity, $1,000, and the cash the issuer receives is the premium. So it's certainly a benefit to the issuer, and the benefit is additional income. You got more cash in the door. The last thing to consider for this video is we have to amortize, new term, the premium on bond payable, meaning that we need to recognize the income over time, which in this case is 10 years till maturity. We call recognize the income amortization. I'm going to keep it easy and say that we amortize the premium evenly over 10 years. So if I take $20 divided by 10, $20 premium divided by 10, it's $2 a year. So what I do is I reduce the premium on bond payable account by debiting. I reduce it. And I credit bond income to increase income. So I gradually take it out of premium on bond payable by debiting. I credit bond income, increasing it by crediting. And that's how we account for a premium on bond payable. Again, the new book, Cost Accounting for Dummies, is out. That's as far as we're going to get today on the bond discussion. Here's the website and the email for one-on-one individual tutoring. You'll also find my author page on Amazon.com. And you can go to my website for the toughest accounting courses that I teach in small group sessions. Thanks very much, and we'll see you next time.